Well, the big question that we've been pondering with many of our guests is, are we in a bear market rally? Has there been a change in sentiment toward this market in general now that we're potentially seeing a less aggressive U.S. Fed? Well, to help us answer some of those questions, we've got Grant Patterson, who's joining us from Providence Wealth Management. Grant, it's so nice to see you here again. Thank you for joining us. We got a bit excited there, didn't we, after last week? Big turnaround in the S&P 500, a couple sessions of gains here locally. But is that enthusiasm, well, has it been misplaced?
Well, I mean, the jury's still out. You can expect after big falls that we've had that you get a rebound or a readjustment in markets. And the question now is it a bear market rally or have we seen the worst of it? And as I say, the jury's still out. I'm not convinced that we've seen a major change in the fundamentals that would actually warrant the markets to continue at this stage. But as we saw in other bear markets, the bear market rallies can be very strong. So, like in 2000, we had one rally there which was up 55%.
Really?
Yet the market was still down, 78 from peak to trough. We had about 8 occasions where the market was up by 18%, and it was still in a bear market. So, early days yet to pop the champagne corks. I still think it's time to be a bit wary about the earnings outlook.
I mean, do you look for signals, whether it be on a chart or whether it be, from policymakers or whatever it happens to be, to get a bit of a determination on, when maybe the worst is behind us, when you can say, oh, okay, this is just, this is more than just, a bear market rally or what have you?
Yeah, I mean, as my friend and your friend Jonathan Payne quite often says, when the facts change, I reserve the right to change my mind. I think in regards to technicals, the 200-day moving average, I think, is quite important to see a major change in longer term direction. So we'd be watching that pretty closely. Capitulation indices, we'd be watching pretty much to see where the investors given up, and therefore there's some real value around. And sure, if there's a change in rhetoric from the Fed or from the inflation outlook, then that would change our mind. But it really comes down, I think, to valuations. Long-term valuations were only about averages, and there's still some uncertainty, I think, in regards to corporate earnings, given high input prices, high wage costs, that are still going to be around for some time. Yeah,
Grant, you've pushed the point about corporate earnings a couple of times, and so let's explore that a little bit, because we had some companies out in the US, Target, Walmart, Snap. Those were updates that were enough to sort of shock the market, really got a lot of the selling and the sellers to come to the fore. But do you think we're just at the tip of the iceberg in terms of corporate earnings? Well,
traditionally, analysts tend to be behind the curve a little bit in regards to earnings expectations. So if we just look behind it, there has been some downgrade in earnings expectations starting to be built into the market, but we're still in the growth stocks looking for 15% types earnings growth, and in the more cyclicals about 8.5%. Now, my question is, will there be any earnings growth when you've got higher and elevated input prices, you've got lack of staff and higher wage costs coming through, you've got higher debt costs still coming through, and you've probably got a fairly cautious consumer, given that their savings rate has declined a lot, still sitting on a fair bit, but the savings rate has declined a lot, and the government's not going to be handing out as much money anymore. So if I was a corporate and in the boardroom, I'd be very much wary about what the sort of next year's earnings and the year after is, and therefore the P's may be a little bit more elevated than what we think.
Well, the Fed, for example, tells us that really its main transmission mechanism is through financial conditions, which is a sort of roundabout way that it says it wants stocks lower. I don't know if you've checked it, but what are financial conditions at the moment looking like in the States? Are they becoming restrictive?
Well, I mean, the market's actually doing a lot of the work for the Fed already. The high US dollar is putting some pressure, and as I mentioned before, with the higher input prices, that's slowing the economy. The market's still expecting the Fed to raise interest rates quite aggressively, and here in Australia, I'm not convinced we'll see that, because I think we'll see a bit of a much stronger slowdown coming through, and that's why we're buying Australian government bonds at the moment for that reason. So I think with financial conditions, they are tightening. I think the other issue that we need to keep an eye on is the structure of the market has changed a lot. over a period of time where you've had a lot less market participants in the market who would normally be there to dampen the volatility on the way down. So, as we had retail investors rush into markets through the passive area, which kept buying the same stocks, the reverse can happen. As they drawing money out, the same stocks keep getting sold. So your volatility could be quite a lot more. And the Fed has indicated that they're watching very closely liquidity and any systemic issues that might arise.
Australian government bonds.
Boring.
Well, where else are you allocated then?
We have taken advantage of the bonds in Australia above 3, so 3.5 or so. We think that's factoring in a lot of the higher interest rates. I mean, the inflation rate we expect to remain elevated, but the rate of change is going to decline. We're going to see that come back down. We're also looking at assets that can protect us in an inflationary environment through their cash flows. So things like retail, suburban shopping centres still have some rental increases linked to inflation. So assets that have infrastructure's another area that we're looking at. And as we've mentioned before, our regional hospitality assets are pretty well, attuned to that inflation area. We've still got our gold. We're happy to have that in the portfolio. It seems to protect portfolios better than cryptos, so we'll stick with gold at this stage and just remaining pretty disciplined. It's
following on from our previous guest talking about crypto. Has it provided any diversification whatsoever, or is it just another high beta tool?
Well, it hasn't, and it hasn't protected you against inflation, and it hasn't protected you against a market downturn, and it hasn't protected you against the US dollar. So the answer is no. As you know, my argument on crypto is more, is it a valid asset allocation or asset class? No. It's part of your fund bucket, and it can be very volatile, and that's fine if that's what you want to play, but it hasn't shown the diversification. It's really a risk on, risk off type trade, and we've seen that risk is back on Friday in the States, and Bitcoin's rallied and stuff. So it seems at this stage still to attract the flows of funds on a trading basis.
And just to leave our viewers with perhaps the thought on the mindset that you need to be in. You mentioned diversification a number of times right now, because we could see this volatility continue. We could see more warnings coming through on earnings. So what are sort of the tools of the trade, the tricks of the trade at this part in the cycle?
Well, you've got to get rid of emotion. Like we've had some big falls. I mean, the average stock in the broader market in the States, the Russell 2000, is down 47%. The average stock in the Nasdaq's down 50%. So there is some value out there, and I think this time around it's going to be where active management will work very well. There'll be a high level of dispersion in returns, which is good, and there's going to be some great opportunities. We're now looking at distressed debt funds, distressed credit funds, secondaries in the private equity. There's going to be some really good opportunities. So the trick is, my 40 years is trying to get rid of the emotion during these period of times, focus on the fundamentals, remember that a price doesn't actually reflect a value, and just remain disciplined.